On Business Incorporated today, Africa's economic growth slows, and that's because of Nigeria and some other African giants. We look at how small businesses are navigating through the removal of subsidy in Nigeria. And Ethiopia's telco gets a boost from the World Bank. Good afternoon. Welcome to Business Incorporated on Channels Television. I'm Ini John Mekwa. Well, I like to say again, thank God it's Friday. Let's see what the markets are looking at intraday on this Friday. We start with Africa as usual and see that the NGX is maintaining that bearish sentiment, even though it's marginal. It means anything could happen before the close of trade, and now still at that 55,900, 949.09. South Africa follows suit at intraday 0.04% in the red at 76,985.06. Go to Egypt now. See what's going on there. Egypt 30 is closed today. Their last trading day for the week is normally on Thursday, but they closed positive 1% exactly. 17,521.36. Kenya closed on Thursday in the red. 0.50%, still maintaining their 100 level index point. Move to the Middle East now and see that our major Middle East markets are closed as usual on Friday. We have two of them open, and that's Abu Dhabi. Abu Dhabi is green at intraday 0.30% at 9,379.53. Dubai also green 0.30%. Pair there, you see 3,698.80. The other two markets are closed and closed on Thursday, positive and negative. Saudi Arabia positive 0.21%. And Qatar negative 0.38%. Let's go to Berlin now, see what's going on there. The EU has announced a massive investment in semiconductor manufacturing, all with the goal of becoming less dependent on China. We have Lars joining us now with the details. Hi, Lars. Happy Friday to you. So what's this EU? What are they planning to do now?
Yes, thanks for having me. The EU has started a program called Important Projects of Common European Interest, and it's supporting those interests with 8.1 billion euros. Now add to that 13.7 billion invested by companies, and you have an investment plan of almost 22 billion euros, and it's all to strengthen chip manufacturing in the bloc. There will be over 60 projects spread across several nations, including France, Spain, Austria, and the Netherlands, and there will be 31 projects in Germany as well. Some are with large companies like Bosch and Infineon, but there's also some startups being supported. So it's a pretty broad effort to build up an infrastructure that will be less reliant on China. And we've seen that that's absolutely necessary, whether it was the pandemic or general political tensions. It's been clear for a while that the West has to make an effort to be less dependent on China and build up their own microchip infrastructure. And that's also why one project has actually been taken off the list. Chip manufacturer Nexperia was initially one of those green-lighted for EU support, but that company is owned by China's Wingtech and has been excluded.
Yeah, well, the tension between this relationship these countries have been on, but how are German companies looking at their businesses that are already in China?
Yeah, they're not in a good mood. A new survey is out that takes a closer look at German companies' business in China. Now, business in China has not been very strong in recent years anyway. There was the pandemic, there's geopolitical tensions, as I mentioned. And biggest problems right now, of course, include China's support for Russia in the ongoing war in Ukraine, as well as China's treatment of Taiwan. Now, more than a third of German companies in China are expecting to see things becoming more difficult this and next year. They're expecting profits to drop further, but more than half of those German companies in China say that they still want to increase their investment there just to be in the game, because that's how important China is.
And businesses as well as markets have long tried to figure out a new China strategy. Have they been able to get something out of that?
Yeah, that's true. How to deal with China has long been on people's minds here. And recently there have been a few new words that we've heard more regularly out of Brussels and also out of national governments. Initially, they've been talking about decoupling from China, but that is really hard to do. The West can't do without China because that country is not only a massively important manufacturer of all kinds of things, but also, of course, a huge market with consumption rising for years and wealth growing for a bigger share of the population. So the new word is de-risk. That means, of course, to have a close business and trade relationship with China while making sure not to be too dependent on a level that threatens business here, because that's exactly where we are at this point. And we've seen this during the pandemic. We have massive problems as soon as trade with China slows down. So the aim is now to put up safeguards and to invest within the EU to become less dependent.
All right, Lars, thank you so much for that. Still looking for the China strategy. Hope we'll find it one day. Enjoy your weekend. All right, let's go to the UK now, where the latest World Bank inflation projection is driving market decisions. Well, Juliana would tell us this and a whole lot more from our London studio. Juliana, good to speak to you again. But we see that UK lenders are removing mortgage deals from the market again as they prepare to reprice home loans to account and capture inflation. What phase could we expect this repricing to have?
Good afternoon, Innie. We'll just have to wait and see, but there certainly appears to be some instability in the housing market sector, not seen since the results of the mini-budget in September, when, of course, we know that Liz Truss, Rishi Sunak's predecessor, caused so much havoc. And this is all down to inflation. We know that last month, or for the month of April, inflation came in at about 8.9%. And I believe that there were those in the housing market that were trying to forecast inflation to be much lower than that. And because of that, bond yields have risen and lots of lenders have started to remove their housing prices at very little notice. That has been the big issue. We've seen HSBC yesterday removing all of their mortgage offers. Nationwide, which is the second biggest mortgage provider in the UK today, have announced to prospective home buyers that they're also going to be removing their products. And this is a huge issue, particularly because we know that consumer confidence at the moment is very low. Although mortgage approvals are quite high, the fact that people are paying a lot more for their mortgages at the end of the month because of high interest rates is a big deal. And now we are expecting interest rates to rise much higher. It's currently at 4.5%. That was what the MPC rose it to during their last meeting. But even though inflation has come down below double digits, it is still very high. So a lot of people who are not on a fixed mortgage are paying up to £500 a month more. And this is set to continue if inflation does stick and interest rates continue to rise. So that's a huge issue. It's causing so much concern, which is why the housing sector is trying to get ahead of the Bank of England. They're withdrawing all of these products, and it's causing lots of turmoil for those prospective buyers.
Yeah, obviously, anything that has to do with housing, accommodation is a basic of life. But what's this talk about Tesco, that they could be breaking the law over how it displays club card prices?
Yeah, this is a big issue, and I think anybody in the UK that shops in Tesco, which of course is the biggest supermarket store here, would be confused about the Tesco Club Card. Tesco Club Card is basically a membership that offers those who are part of that membership a discount. So if you go into a store, you'll see a big yellow sign that says the price, but if you look a little bit closely at the small print, it actually tells you the real price, which is always so much higher, and which is a consumer regulator has been tasked by the Competition and Markets Authority to investigate Tesco, because lots of customers have said, the price of bread said £1, and you get to the counter and you realise it's £1.80, and so now they're probing Tesco to find out why exactly they are doing this and what they can do to protect consumers, because of course we are going through a cost of living crisis, as we discussed extensively this morning, Innie, on Business Morning, and consumers want the best for their money. And I think regulators believe that Tesco are not doing enough to make it clear exactly what the prices are. And the story is much deeper because, of course, again, if you are watching from the UK, you'll know that when it comes to shopping and it comes to a yellow sign, most people associate that with Lidl, which is a disruptor of the big four supermarkets in the UK. It's a discount retailer and they're known for their yellow sign. So even in a High Court ruling a couple of months ago, judges here in the UK said that Tesco have basically ripped off Lidl by using that yellow sign, which is known as a budget sign, to try and attract and lure customers. But the problem is, if you go into a Tesco supermarket and you see a yellow sign, a big yellow sign advertising a certain price, you actually think that's the price you're going to be paying at the till, when 9 times out of 10, you're not going to be paying that price. Tesco have refuted some of the allegations that have been put to them by Which, but it is a big concern because we know that consumers are still very beleaguered, still very much struggling with the amount of money they're getting paid at the end of the month to be able to afford these products anyway. So I think now the British government are really clamping down on supermarkets to make sure that the prices that they display are actually the prices that people pay at the end of their shop.
Yeah, talking about strategies to survive the high cost of living over there, Juliana. But how are investors positioning in the markets at this time?
Yes, we're almost at the close of market trading, but the FTSE All-Share is down. It's down at intraday by 0.41%. The FTSE 100 is down 2 by 0.39%, and the FTSE 250 down 2 at 0.53%. In the currencies market, the British pound is currently trading down against the US dollar by 0.10%, trading up, though, against the euro by 0.10% and up against the Japanese yen by 0.41%.
Thank you so much, Juliana. Very well delivered. Have a great weekend.
Thank you. Have a great weekend, Innie.
All right, let's go to Asia now, where markets traded mostly higher after the S&P 500 closed at a new high for 2023. The Dow Jones Industrial Average saw a third straight day of gains. Investors digested China's Consumer Price Index, which saw a 0.2% rise in May, and its producer prices that fell 4.6% year on year, making the steepest drop since May 2016. Let's look at the numbers now and see that Nikkei 225 closed at almost 2% higher, 1.97%. That's a good one, 32%. That's 2,265.17. The Shanghai Composite, more than 0.5% in the green. We see there 3,231.41. The Hang Seng Index also looking good along that range. The Kospi, better than that, 1.16%, 2,641.16. And in Australia, it's 0.32% in the green, 7,122.50. Go straight to the United States now, where stock futures ticked lower in early trade on Friday after the S&P 500 notched its highest close. That was a driver in the Asian market. But let's go over and take some steps and see how this happened with our correspondent, Maria Bird, giving us some details of Thursday's trade.
The U.S. stock market was up on Thursday, as the Dow Jones was up by 0.50%, the S&P 500 up by 0.62%, and the heavy tech NASDAQ up by 1.02%. This pop in the U.S. stock market has many investors hopeful, as it is clear that the S&P 500 has officially entered the bull market, as it's up 20% since October of 2022. Many investors are also watching to see the economic reports, which have been positive. And this is a sign that potentially next week's meeting with the Federal Reserve will be one that will sustain interest rates and not have any major increases. Investors still watching to see how the market plays out, but they are looking forward to the days and weeks ahead.
All right, thank you so much, Maria, and I hope that the S&P 500 will do much better next week. But to follow up and let you know, let's take a break now on Business Incorporated. When we come back, we'll tell you how businesses, especially small businesses, should hedge with the impacts of the subsidy removal going on in Nigeria. That and a whole lot more. Stay here with us on Business Incorporated. Welcome back to watching Business Incorporated here on Channels Television. Now let's look around Nigeria. One of the biggest stories going on at this time is the issue of the fuel subsidy removal and the impact it's having on transportation and businesses. Earlier today on our Business Morning show, Business Morning, we did speak with the chief economist of KPMG, Mr. Yemi Kale, on some of the impact on businesses and how small businesses can hedge against it.
What needs to be done as far as businesses are concerned, they're going to have a shock on both sides of their businesses. One on the demand side, because obviously their consumers are having their purchasing power reduced. So as a result, they'll end up demanding a lot less of their products. So they're going to have declining sales, but at the same time, they're having increases in their cost of production directly from the increase in the PMS, indirectly from transportation costs. And there's even a chance that their staff might demand higher wages to cushion the effect of the PMS increase. So they're having higher costs, they're having lower demand. It's a very challenging period for business in the country. I would say, in my opinion, the way they can hedge against these challenges, find new areas, expand, diversify your income streams across various businesses so as to be able to hedge against this risk, preferably in the production of the provision of services that are non-discretionary by nature, which means that consumers have no choice but to consume those commodities. So they'll have a lot less impact on their earnings. At the same time, be more efficient with the expenditure profile. Cut out any discretionary expenditure that you can cut out, be a bit more efficient in the way you spend money, in the way you move your goods and services around the country. So much more efficient expenditure, a much more efficient expenditure structure, and expand the number of earning opportunities in your business.
Talk about some strategies that small businesses could adopt in Nigeria at this time. Now let's go to South Africa, where that country has avoided a recession, unlike the Eurozone, where we see that the Eurozone is now in recession. And this is in the first quarter. That's where South Africa is back above pre-pandemic levels following the growth of most sectors. Gross domestic products expanded 0.4% in the first 3 months of this year after contracting in the previous quarter. That's according to Statistics South Africa. We have expanding this for us, Matt Kindiger, practice leader, Sub-Saharan Africa. Front of You joins us from London. Hi, Matt. Good afternoon.
Hi, good afternoon. Thanks for having me on the program today.
Yeah, so do you expect that the government will adjust its spending and tax plans over the coming year to stabilize public financing? I mean, with this escape of the recession that has been recorded?
Yeah, so what we would expect is that the government will probably continue its current plan at the moment, which was set out in the February budget speech. So the fact that the economy grew very slightly in the first quarter of the year does mean that the current plan to avoid tax increases, so delay tax increases and minimize spending cuts, will probably continue right until the end of this year, until the next midterm budget speech. But I would say it all depends on how public finances progress over the next few months. So what we have seen in South Africa is interest rates increase quite significantly over the last few months. We are expecting the South African Reserve Bank to continue raising interest rates. This will increase the cost of credit and debt servicing for the government in South Africa. And we are also expecting to see the economy slow over the winter. So although the economy avoided a recession in Q1, there's likely to be weaker growth over the course of this year, and this will affect tax revenue, and it will require the government to spend a bit more. So this all means that the government is likely to face greater fiscal pressure towards the end of 2023 and into 2024, and we could see for the first time in many years, some significant tax increases and some more significant spending cuts. But it is complicated by the fact that there is an election next year, and the government won't want to raise taxes too much or cut spending too dramatically to avoid the political costs associated with that.
Yeah, talk about political consideration there. But I mean, a lot of people, Matt, would say that, I mean, it's even a miracle that South Africa has escaped recession, because with the power outages and the impact it's had on economic activities, you know, you would have expected. But how do we see this affecting the growth outlook of South Africa?
Yeah, so I mean, it is a very positive sign that the economy avoided recession. We were monitoring this very carefully and very closely. There was a higher or increasing chance that the South African economy was going to contract in the first quarter of this year, and it's good that it didn't. And this does this kind of illustrate the resilience of certain industries in the economy, especially in services. So services, financial services, ICT, for example, doing very well in the country, transport also doing very well. So certainly there are a number of industries keeping the economy afloat. We also have seen South Africa's economy benefit from relatively high commodity prices for the commodities that it exports, like iron ore and coal. In terms of the growth outlook, I would say, unfortunately, it is a bit more uncertain. We are expecting the economy to struggle to grow overall. So we are expecting to see growth slow towards the end of this year. And if we do see worsening load shedding, we are likely to see the economy fall into a short recession, especially, maybe the end of Q2 when the data comes out, or Q3, or maybe even early Q4. It's unlikely to be a deep recession, but certainly the economy faces real risk of contracting this year. We're currently forecasting growth of 0.6%, but we are likely to downgrade it over the next 3 to 6 months or so. So more or less stagnation for this year, a slightly more upbeat view for 2024.
All right, looking at the Rand, I know that the Rand received some bash, especially when the BRICS foreign ministers met in South Africa. We saw it drop to a record low. But so where are we seeing it get? What position do you see it getting in the coming months?
Yeah, so the Rand did reach a record low over the last couple of weeks, as you said. It has now retreated from those record lows, so it's made up a bit of value against the dollar over the last week or so. But our view is that we would expect the Rand to reach new record lows at least over the next 6 months or at some point. So we are expecting it to reach over 20 per dollar, probably within the next few months. And then there will likely be a period where it exceeds 22, maybe even 23 per dollar before the end of this year. Having said all of this, it does depend very significantly on a number of factors that could pull the Rand in either direction. So the Rand's value is very sensitive to global growth. So if we see a quicker than expected economic recovery globally, investors towards emerging markets, including South Africa, will invest a bit more in South Africa, and we are expecting the Rand to benefit. Having said that, the Rand is also incredibly susceptible to political developments, both domestically and globally. So if we see South Africa's relationship with Russia getting a bit closer, then the Rand is likely to lose a bit more value. And finally, if we see load shedding get a lot worse in South Africa, especially during the winter, we could also see sentiment turn against the Rand. So the takeaway really is a bit more depreciation of the Rand. We could see new record lows before the end of this year, but there will be periods also of appreciation, especially as the South African Reserve Bank is likely to intervene and raise interest rates to try to stabilize the Rand. So a bit of up and down for the foreseeable future.
All right, Mark, thank you so much for that insight into the economic growth of South Africa. Matt Kiniga, Practice Leader, Sub-Saharan Africa, forefront of you.
Thanks very much.
All right, now moving on now, talking about South Africa. South Africa, Egypt, and Nigeria are responsible for 65% of Africa's gross domestic product slowdown. This is contained in the latest report by global management consulting firm McKinsey & Company. According to the report, Africa's GDP by 2019 should have reached $3 trillion, not $2.6 trillion, if the three countries had maintained their growth rate between 2000 and 2010. The firm stresses that Africa is home to the world's youngest and fastest growing population, yet its economic performance has lagged. It further notes that since 1990, the continent's GDP per capita had only grown by 1% annually, compared with India's 5% and China's 8%. And finally, on the program, the World Bank has pledged to support Safaricom, Ethiopia's greenfield telecommunications network across the country with an investment worth over $200 million. Two members of the World Bank Group and IFC and Multilateral Investment Guarantee Agency will support the ongoing construction and operation of the project, leading to more affordable internet, reliable mobile connectivity, and technology access for people and businesses. The partnership will address the World Bank Group's core mandate to help countries end poverty and meet their citizens' demands for services, including digital connectivity. Following the deal, IFC will hold a minority stake in Safaricom Ethiopia. That's where we draw the curtains for today. Thank you so much for being a part of Business Incorporated. It starts all over again on Monday, so to join us then. Have a great weekend. I'm Ini John Mekwa.